Hello and welcome to London Eye. I'm SHEREEN. We're at SCHRODERS in conversation with the economist looking at emerging markets. Craig, appreciate you joining us here on CNBC TV 18. Well, before I talk to you about India, let me ask you about China, because you've just come back from China about a week and a half ago. What's your own sense about what's going on in China at this point in time? Have the fears of a hard landing, receded a tad?
I think certainly there was no evidence of a hard landing being covered up in China whilst I was there. I think activity is, maybe not quite as high as the data is suggesting, but it's still ticking along. But I am more concerned about the medium to long-term prospects over there. I think there's still a lot of problems to be sorted out and resolved. And not much progress has been made in some cases.
But is there an acknowledgement of the problems, specifically the debt issues?
We did find that both in the private and public sector in China there was a much more candid acknowledgement than on previous trips. So I think, yes, the government is aware now and will be working towards resolving them, whereas in the past we found that there's a bit of a blind eye turned, at least on the official soundbite side.
What does that mean then as far as reforms are concerned, whether it's state-owned enterprises, it's market reforms or financial liberalization or further financial liberalization? What is your own sense about what we can expect as far as the reform process is concerned in China?
I think so, compared to the third plenum when there was a lot of talk about market-orientated reforms, a lot of that has died back now. Reform seems to be much more concentrated in terms of, or focused rather, on concentrating power at the central level, so giving more and more levers of control to the central government. So if they can have market-orientated reforms which do that, that's great. Otherwise they don't really care, they're not interested. And there's still a sense that they don't really understand what investors want in terms of when they're opening up their markets and opening up things for investment. They don't want to give control to private sector investors with public-private partnerships, for example, or with equity stakes. It will always be minority stakes with no control. And so there's a sense that although they are opening up, they're still not giving the private investors, particularly international investors, what they want. Okay.
So what is the growth forecast that you're working with as far as China is concerned, both in the short term as well as over the next few years?
So in terms of the published numbers, we're expecting sort of 6.8, 6.9 this year.
Which is aligned to the government's own estimates?
Yes, exactly. I think at this point, only 1 quarter left to go. There's only so much variability there can be versus the consensus. But over the next few years, we are expecting a gradual slowdown, so coming down to, say, we're still looking to finalise numbers, but maybe around 6.3 next year, and then going down to 6 and below thereafter. What I would be most concerned about, to me this path is okay, it's nothing to worry about, it's what you'd expect, given how rapidly China has grown. What would give me worry is if the government tried to resist this slowdown and tried to keep growth at, say, 7%, or just tried to keep it at 6.5% for a prolonged period, because that would be pushing above trend for too long, and eventually you'd need to have a much sharper correction downwards.
But do you get that sense that that is exactly what's likely to happen?
It's difficult. So we're yet to get an official number for the new 5-year plan and for 2016. There's been suggestions it will be 6.5 for 2016, which would be okay. If it was 6.5 for the 5 years as a whole, I'd be a bit more worried. In general, the governments at both the national and local level seem to be moving away from hard targets. So actually Shanghai earlier this year dropped a hard number altogether. So that gives me a little bit of hope that they will try and be a bit more flexible. I guess one question is just how they prepare the populace for this change, because up until now they've always been beating the growth targets, and so it's not been a problem at all. All of a sudden they're in an environment where they're struggling to hit these growth targets, and it's just sort of managing how that's received by the population. Certainly last year when we were in China, the news channels were starting to tell people that actually, you know what, high growth isn't all that matters. You also need good quality growth. So although growth is slowing, look at how much better it is for you now. So maybe we'll see more of that going forward.
One of the concerns that people have when we talk about China, besides the fact that it's slowing down, because that impacts the rest of the world as well, is what they're likely to do as far as the currency is concerned. The devaluation did come as a big surprise. Do you see more of that?
I think it's inevitable. The reason I say that is because just on a macroeconomic level, if they want to have an international currency, at some point they have to make it more freely convertible, which means opening up the capital account. They also want to target the interest rates in China. They want to keep control over the interbank rate and the lending rate and so on. And you can't have both of those things and have a pegged currency. So at some point, as they ease up in capital controls, they're going to have to let the currency go. The question is whether they go for one big bang or they do several small steps.
Do you believe it will be calibrated?
I think they are very nervous about the stability impact of any move on the currency, given what we saw in August as a result. You know, the outflows that resulted. Certainly people now within China, both individuals and institutional clients, reported as looking to diversify away from RMB a lot more, so there will be a portfolio diversification effect. So they are aware this is going to be an issue. I think what will be important is to signpost it very clearly, to manage expectations. The alternative route would be to go for one big bang, so that you can then credibly say, okay, that's all the devaluation done. So then there's no point having massive capital outflows, because you can no longer play the currency like that.
But whether it's calibrated or it's in one fell swoop, what kind of move do you actually see as far as the currency is concerned?
I shy away from making currency predictions, because they always end up being wrong, and there doesn't seem to be any real way of getting it, because you can try and say, on a valuation model it should be this, but markets typically overshoot and undershoot, and it never ends up being where you think it should go. Certainly further weakness compared to the current position seems warranted, but it's not. So like I said, there's the portfolio diversification angle. So people will want to move assets out of RMB and into dollars and other currencies, just from that perspective. But in terms of other factors which support the currency, you have a current account surplus. Obviously, FX reserves are very strong, and actually interest rates within China are still higher than in much of the rest of the world. So I wouldn't expect that you'd need a dramatic weakening. You could have an overshoot, but I'd say it shouldn't go beyond, say, 7 to the dollar. But again, I wouldn't take that as a hard target.
Sure. Since you're talking about the central bank, and we've seen, a significant aggressive intervention on the part of the central bank in China, along with other measures announced by the government. Are you seeing signs of all of that beginning to work?
I think so. We had some more data out of China this morning, actually, and we've had some initial signs of improvement. Investment has started to rebound a little bit in terms of the monthly data. So the headline reported number is a year-to-date figure, so obviously includes all the weakness we've had so far. If you look at the month's number, it's bounced back quite significantly from last month. Industrial production, it's true, weakened a bit more, but retail sales has come back. The property market, in terms of the last few months of data, actually land sales have been picking up, property sales have been pretty strong, and you've actually seen a bit of stabilisation as well in new starts. So there is some sign the stimulus is having an effect.
Do you think that this doing away with the one-child policy, which was already announced about a year ago, is going to make any significant difference as far as the economy is concerned?
I think no short-term impact whatsoever. I think medium-term, maybe a marginal impact on the economy, but you have to remember that when they relaxed the policy last year, they basically made 11 million couples eligible for a second child, and only 1 million applied to do so. So I think that we're going to see a massive take-up of this, and even if we do have a take-up, it's going to be 15-20 years before we have a real impact on the economy.
Okay, so let's talk about India now. Your visit to India was in February, so it's been a while since then. Several things have happened. Of course, India is the biggest beneficiary as far as oil prices are concerned, and the current trend as far as crude suggests that we will continue to enjoy that comfort. The macro situation has improved considerably. We are now seeing monetary easing as well. How strong is the India macro story looking today?
So you're right, there's benefited a lot from commodity prices. I guess one problem for me is that the year-on-year effect of that is now going to be greatly diminished, because it's all sort of come through. So India, in a way, has had a lot of the easy gains in terms of it managed to cut its subsidy for fuel at the time when oil prices fell, which is great. It's done some fiscal consolidation, but a lot of that has come from one-off things, so using disinvestment to reduce the deficit, cutting down on capex spending, which you can only do so much of. Going forward, obviously the banking system still has asset quality issues, and so there's a question over how rapidly credit provision can ramp up. I think one strong side of the Indian macro story is the consumer. We're seeing a good uptake in consumption there. On investment, as asset quality would suggest at the banks, a lot of corporates are not in a position to invest, but I think if you look at a more granular level, a lot of the really high leverage is concentrated in particular sectors, utilities, for example, which is obviously bad news for infrastructure spending, but it does mean that there's a large part of the corporate sector which could spend if it saw the need to. So as consumer spending comes in a little bit higher, potentially corporates can invest more. So I think growth can continue to marginally edge up for the next couple of years.
What do you make of the GDP print in India? Because of course it continues to cause controversy. Do you buy the 7.5%, 8.5% numbers? The 8.5%, of course, is the forecast.
Sure, I mean it's growing faster than China, which is fantastic. I think It's difficult. So when you compare it to the old GDP series in terms of how it matches up to higher frequency data, the old GDP series did actually quite a good job. So you say you combined industrial production, retail sales, or consumer spending rather, and other measures. And compared to GDP on the old measure, they moved more or less together. The new series doesn't really seem to bear much relationship at all to that combination. And so it makes me think that something isn't quite right with the numbers, and so I'm a little bit sceptical about that. But as an emerging market economist, you get quite used to that problem.
So given what the new series is and what you're seeing as far as the high frequency data is concerned, what's your own forecast as far as India is concerned?
So again, revising them at the moment, but it's currently at around 7.2 for this year and around 7.6 to 7.8 for next year.
So you don't see an 8.5% kind of growth number for
I
India?
would be very sceptical if that came through. It's difficult to see where that would come from as a stimulus. Given that we should have had a much bigger jump this year, given all the external benefits India's had from commodity prices, given the easing we've had, given this government spending we've had, it's difficult to see why all of a sudden growth would jump by more than 1% next year. I would say that 8% growth is achievable in the medium term for India, but we need reforms first. There's so many structural factors holding it back. It's a long way from being the next China in terms of its contribution to world GDP.
Pleasure speaking with you on London Eye. Thanks very much for joining us on CNBC TV 18.
Thank you.
With that, it's time for us to wrap up the show. We'll see you again next week. Till then, from the entire team, goodbye. Many thanks for watching.